Hello everyone, my name is Kanchan Yadav and welcome back to Learn Accounts with Kanchan. So in today's video, we are going to understand the company's cash flow statement. So as we all know, cash is a bloodline of a business and it is very crucial to understand how it moves for understanding the company's financial statement. So in this video, we are going to understand the company's cash flow statements, its identity, its definition, and also three important cash activities, which is none other than investing, financing, and operating activity. So without any further delay, let's begin. So, what is cash flow statement? A cash flow statement is a financial statement that shows cash inflows and cash outflows. Cash inflows means cash coming into the business and cash outflows means cash going out of the business. It explains how the cash position of a business changes during a particular accounting period. Now the question may stuck in your mind is that why is cash flow important? So, cash is the lifeblood of a business. A company may earn the profit but still face a shortage of cash. A cash flow statement helps us to understand the source of cash, identify where cash is being spent, evaluate the liquidity position, plan future cash requirements, and assess the ability to pay the debts and expenses. So the main components, cash flows are classified into three activities: operating activity, investing activity, and financing activity. Operating activities, cash generated from the main business operations. Investing activity, cash generated to purchase or sale of long-term assets and investments. Financing activity, cash related to capital and borrowings. Operating plus investing plus financing is equals to net change in cash. Now, operating activities. Operating activities are related to the day-to-day operations of a business. Example of cash flows. So here, cash received from customers, cash received from fees or commissions. And example of cash outflows are cash paid to suppliers, cash paid to employees, cash paid for operating expenses. For example, a company received rupees 1 lakh from customers, operating cash inflow. Investing activities. Investing activities involves long-term assets and investment, cash inflow, sale of machinery, sale of land or buildings, sale of investment. Cash outflows, purchase of machinery, purchase of land or buildings, purchase of investment. For example, a business purchases machinery for rupees 2 lakh, investing cash in outflow. Now the last one is financing activities. Financing activities related to raising and repaying the funds. Cash inflows, issue of shares, issue of debentures, taking loan, and cash outflows, repayment of loans, redemption of debentures, payment of dividends. For example, a company takes a bank loan of rupees 5 lakh, then financing cash inflows. Now here is difference between cash inflows and cash outflows. Cash inflows, cash received from customers, and cash outflow, cash paid to customers. In issue of shares, purchase of machinery, taking a loan and repayment of loan, sale of assets, payment of expenses, sale of investment, purchase of investment. So here inflow is cash comes in and outflow cash goes out. Now for your better clarity, here is direct and indirect method. Cash flow from operating activity can be calculated using the two methods, direct method and indirect method. Direct method shows the major classes of actual cash receipts and cash payments. For example, cash received from customers minus cash paid to suppliers is equals to operating cash flow. And indirect method starts with net profit or loss and adjust for non-cash item, non-operating item, change in working capital. So the indirect method is widely used in practice. Now here is a basic format of cash flow statement. Simple format is cash flow from operating activities or either plus minus adjustments. So it is equals to net cash from operating activities, cash flow from investing activities which is equals to net cash from investing activity, and cash flow from financing activity which is equals to net cash from financing activity. Then net increase or decrease in cash plus operating cash balance is equals to closing cash balance. Now for your better understanding, here is a simple example. Suppose a business has operating cash flow rupees 80k and investing cash flow is rupees 30k, where the financing cash flow is rupees 20k. Therefore, net change in cash would be rupees 80k minus 30k plus 20k, which is equals to 70k. If opening cash balance is rupees 50k, then closing cash balance would be rupees 50k plus 70k, which is equals to 1,20,000. Now, here are some advantages. Advantages of cash flow statement. It helps to assess the liquidity. It shows the actual movement of cash. It helps in cash planning. It helps in make as management financial decision, and also useful for investors and creditors. It helps to identify the potential cash storage, and also it provides information that profit alone cannot provide. Now, in contrast, here are some limitations. It focuses mainly on cash movement. Non-cash transactions are generally not shown directly. It does not measure profitability by itself. Historical cash flow may not predict future cash flows and accurately. It shows may be analyzed along with other financial statements. Now here's a very important difference between cash flow versus profit. So profit never equal to cash. A business can have high profit plus low cash, or low profit with high cash. Why? So the answer is because profit includes non-cash items and transactions that do not immediately affect the cash. Therefore, both profitability and cash flow are important for evaluating a business. Now here's a quick revision. Remember the three major activities: operating, day-to-day business activities, investing, purchase and sale of long-term assets or investments, financing, capital and borrowings. Easy trick is that OIF means operating, investing and financing activities. Now to recapitulate, here's the conclusion. A cash flow statement tells us where did the cash come from, where did the cash go, and how much cash is available at the end. So it is an essential tool for understanding the liquidity and financial health of a business. So remember, profit tells us how much a business earns, but cash flow tells us how will it manage its cash. Now thank you everyone. If you found this lesson helpful, please like, comment, share and subscribe to Learn Accounts with Kanchan. Till then, stay safe, stay healthy and have a good day.